We are joined by two big market voices, somebody who I learn from every single time I talk to them, Nilesh Shah of Envision Capital and Saurabh Mukherjea of Marcellus Investment Managers. Gentlemen, both of you, thank you so much for taking the time out. Is the mood sanguine going into the next Samvat? Either of you can kickstart this conversation, but is the mood a lot more sanguine than what it was last Diwali? Because we have, for lack of a better word, the government action making the market believe that the interests seem to be aligned now.
And last Diwali actually came at a time when we just about started digesting Island FS for a few months.
Yeah, so you could, I think I wouldn't say it's more sanguine or anything like that. I'd probably say that it's as somber or as sanguine as what it was last Diwali. Because I still think around last Diwali, the kind of sense of a economic slowdown wasn't really there. I mean, of course, the economy had started to slow down, but we hadn't got to a 5% GDP growth rate. I mean, the headline numbers were still around, 7%, plus minus 0.5%. And this year, if you look at it, or the last data, talks about a 5% growth rate. So to that extent, I'd probably say that now the sense is that, that we are in the midst of a slowdown, and it's not something which is very temporary or anything like that. I think that's the big difference. Obviously, I think the sentiment might have been worse had the corporate tax rate cut not happened. And therefore, some of the earnings look better because of that, where companies have grown revenues at probably just 5%, but bottom line growth is 25%. So had that not happened, I'd probably say that the sentiment would have been worse than the last Diwali. But I think thanks to the corporate tax rate cut, the mood is a bit better than what it could have been.
The optimist would argue, Nilesh, though, and just a follow-up to that, is that yes, you could have a year or two of growth slowdown, and we don't know how long this will last. But what we have is a lower tax rate and lower interest cost, both of which should boost corporate profitability in the next few quarters. And maybe there is value right now, even if the GDP growth is not looking strong, because, somebody was telling the statistic of how the GDP growth may have done whatever it has done in the last 10 years. The market cap, aggregate market cap, has stayed absolutely flat in the last 10 years. So on that parlance, we are arguably the lowest level in the last decade.
Yes, surely. Of course, those are different data points.
This slice and dice, yeah.
And I think economy is one thing, investing is another thing. And you could find value in even when the economy is totally bad, and you may not find value when the economy is roaring or rocking or firing on all cylinders. I think the bigger challenge right now is demand. And I think, I don't think a developing economy like India or a country like India can afford to have 1 or 2 years of slowdown.
Okay.
We may call it as a reset and all of that, which is all fine. But, nevertheless, I don't think with a population of 1.3 billion people and a per capita of $2,000, we can afford to kind of let a couple of years go in just stagnancy. So I think earnings is one thing, but demand is the other. And my sense is that what India really needs is a pickup in demand. If demand remains stagnant or remains in this mid-single digit, it will create its own set of challenges, which probably may not fully manifest now, but could manifest maybe a quarter or 2 quarters later. So my sense is that the big focus now going forward will have to be on a demand pickup.
Saurabh, coming to you, I'm just quoting Guy Spears here. He said, with regards to short-term investing and long-term investing, he said one is fun and interesting, and the other is long-term investing.
Right.
So, when we're taking a look at long-term investing right now, for a current market environment such as this, even 1 year is not long enough. You need, because of the kind of challenges, volatility that we are facing. So, what would you suggest someone does? Is this adversity an opportunity? Take the ones that you're finding at good values, sit with it in your portfolio, and forget about it.
So look, I think it's a very, very interesting time for I think all of us as investors. I'll use sort of an analogy from a very popular Bengali novel of the last 3 or 4 years. It's translated into English. The title of the novel is there's the smell of gunpowder in the air, right? And I think as Nilesh was describing, a year ago, people were still living in fantasy land. And I remember, over the last 2-3 years, I've been trying to persuade people that the economy is in a very difficult place. But until 6-7 months ago, there were very few people who were sort of willing to believe me that the economy was a difficult place. And we used to get this sort of fantasy style of investing in our country where, investors would buy NBFCs, banks, infrastructure companies, as if you're in a raging economic boom. So the fact that there is a degree of fear in the air, there's a degree of realism in the air, I think is a wonderful thing to have. It brings people's minds into line with reality. And once you start thinking about India realistically, as we've discussed on your show for several years now, there are actually abundant opportunities for making money. Even at 6% growth, there are abundant opportunities to making money because this is a large country. There are plenty of underpenetrated products. You buy those underpenetrated products, look for companies who are selling essential products with high barriers to entry, and sit back, be calm, be patient. You can actually make very good money in this country. So yes, we all are very sensitive to the economic climate. A year ago, we were a little unrealistic about it. I think there's a greater degree of realism amongst both investors and business people about the economic challenges that we face. But once your mind becomes sober, once your mental framework becomes realistic, you're actually far more able to avail of long-term investing opportunities and the ability to make high teens, low 20s returns in India, even in this somber economic climate. So I think it's a great time to be living, working, and investing in India, notwithstanding the economic slowdown. And it's a far more realistic environment with which we enter this Samvat than the fantasy climate that people had last Samvat.
And that brings me to my next question, which is the heavily beaten down space, which is the mid-cap space. Some of the companies probably not bad at all. Just the perception that there is a problem has caused all of these issues within this space. Do you paint them with the same brush, or do you see this as an opportunity again to pick up those quality names which have done well, which have withered the storm, baptism by fire, if you may call it, and they've come out?
So Deveen, I think one thing I've very strongly felt over the years is I think we all get a little too caught up in our market about the labels of large cap, mid cap, small cap. So if I look at our own portfolio, we have names which are large cap which are doing well, we have names which are mid cap which are doing well, we have names which are small cap which are doing well. We're buying all of those. So I'll just take three quick examples. Large cap, easy name to spot, which is doing consistently well, is Asian Paints. We know what it does. It's been doing it for 35 years. It's a 27-28% compounder for 35 years. Right? If you look at mid cap, let's take a name like, say, Dr. Lal Path Labs. Right? It sells an essential service, diagnostics, 35% ROC, consistently has delivered since its IPO, and the company continues to go from strength to strength. And similarly, if I take a small cap example, say Relaxo, right, makes chappals, lower end footwear, dominates the northern and eastern Indian market, 30-35% ROCs, company does well. So as long as you look for these sorts of companies selling essential products, very powerful barriers to entry, clean accounting, clean governance, I suppose every passing week.
You'll be good.
Right? You'll be good. Forget the market cap labels. Look for essential products, barriers to entry, clean accounting. You'll make money. Doesn't matter what the GDP growth rate is.
Right. Nilesh, then bringing me to your thoughts on this whole thing. Obviously, we have bucketed a few of these companies, labeled them as mid caps, small caps, large caps. Now, if you take a look, I'm just throwing examples at you. Bajaj Finance 9 years ago wasn't the behemoth that it is right now. HDFC Bank wasn't this behemoth that it is right now. So it was that kind of an opportunity spotting.
I would differ on HDFC Bank, but yeah, Bajaj Finance, I get it. Come on, let's face it.
But I'm saying it's just multiplied in size.
100%.
Astral Polytech 5 years ago, I mean, the opportunity that it is and the market cap that it is right now was probably maybe a tenth of that.
Yeah.
So in such markets, do you feel that there's enough and more opportunity for everyone to make decent amount of money?
Yeah, absolutely. I think clearly the big opportunity in India is that we are still a developing economy and an emerging market. And so to that extent, you will always have the evolution of new businesses, which either essentially were born just recently or they IPO'd themselves very recently. Okay, and I think two opportunities that we've identified in recent times, one is basically the asset management space, the mutual fund space, and clearly believe that that's a hugely underpenetrated space. And essentially these are businesses which have a runway of growth for maybe the next 10, 20, 30 years. Okay, and they don't need capital and they're very capital efficient businesses. The other is the general insurance base. While everybody's talking about life insurance, but you always run the risk that if the underwriting is poor, you'll realize the blunders only 10, 15 years later. Whereas something like general insurance is like FMCG. You've got to buy your insurance policy every year. There is repeat customer and there's huge amount of stickiness.
And the Indian mindset is such that you keep insuring yourself,
Absolutely.
you keep investing in it.
Even while the markets have not done too well, and you could call these now mid caps, larger mid caps, large caps, you can give whatever nomenclature you want to. But these are outstanding opportunities, outstanding businesses, and I think this is the kind of stuff that we need to look out for in India and not again get boxed into established companies, non-established companies and all of that. As long as there is growth, capital efficiency and governance. These are the three broad pillars on which any investment needs to stand on and make it a very sustainable investment opportunity. So I think that's what we've been basically trying to kind of do in this kind of an environment.
So I actually wanted the views of both of you. Preempted my question, right? Non-lending financials, because of the scare over the last 12 months in the NBFCs, there seems to be this disproportionate shift, maybe warranted, towards the non-lending financials because they're safe. There are no NPA issues, etc. Sorry, Saurabh, you were ready to answer that.
I'll answer your question as well, but I think Davina made a very interesting point, and I think just watching the discourse between the two of you in HDFC Bank, very few people realize this, that companies like HDFC Bank and Asian Paints have grown 10x in 10 years. So HDFC Bank today is $100 billion market cap, roughly. 10 years ago, it would have been $12-13 billion. So it's added $90 billion of market cap, right? So what happens is, and again, this is why it's so important not to get lost in the discourse ki small cap kya hai, large cap kya hai. You've got giant companies giving you giant returns, right? So a lot of clients, when I go to pitch our portfolio, I tell them we have Asian Paints. They say, oh, Asian Paints, oh, such a boring stock. I say, sir, it's doubled in the last 3 years. They say, kisi ne bola nahi, Asian Paints has doubled in the last 3 years. That's the nature of powerful compounding, whether it's Pidilite, whether it's Asian Paints. Bajaj Finance, we all know, has rocketed, right? Page Industries, people know have rocketed. People don't realize that at HDFC Bank or Asian Paints has been a tremendous wealth creator. So when we get lost in false labels, you lose sight of where money is being made.
Sure.
Instead, you're looking for small companies to get big. You don't realize an HDFC Bank
can get bigger.
And HDFC Bank is 100 billion today. My hypothesis is it will easily give you 6-7x comfortably. Can you imagine a 6-7x from HDFC Bank? What that means in terms of wealth creation, right? Yeah. It's got 4% market share in Indian lending. State Bank of India has 40% market share.
Really?
40, yeah, right? So 70% is PSU banks, within which State Bank of India is the dominant. So HDFC Bank is 1/10 the size of SBI in terms of market share. Imagine the wealth creation opportunity. We don't even have to do anything particularly exciting. Coming to your point on and Nilesh makes a very fair point. It's clear that fund management, wealth management, general insurance, life insurance, there are abundant growth opportunities. We're still highly underpenetrated in terms of modern financial savings. Most Indians in your and my social strata have loaded themselves up on real estate, and obviously that's something they're paying the price for. Where I get a little concerned about some of the plays in literally our sector in fund management, wealth management is I don't see the moating, I don't see the barriers to entry. Right, so there are plenty of wealth managers. I think within probably, if I throw a stone from your studio, I'll probably hit 6 wealth managers. That's the sort of degree of preponderance of wealth managers in central Bombay or fund managers. It's not clear what barriers to entry they're building. Right, if you don't build barriers to entry, you will get growth, but you'll not make money. Right, the reason HDFC Bank stands out is it built a barrier to entry around current and savings account. It built a moat, a low-cost funding franchise. Kotak is amongst the few others to be able to replicate that sort of low-cost funding franchise. So you can grow as much as you want. Our airlines, for instance, have grown like a rocket in the last 10 years. But you cannot make money if you do not put up barriers to entry. Right? And I think that's where whichever sector one invests in, look for companies selling essential products like, say, the sort of work Nilesh and I do, fund management services, but also look for companies who are putting up very high barriers to entry.
So non-lending financials, Nilesh, do they have some bit of that? So Saurabh's point is well taken. The argument that the bull might make, and a couple of people have made this, is that one, the branding that some of these large names have draw people to them automatically. I don't know about portfolio management, but at least, I mean, PMS is now becoming an active part of AMCs. Yes. So I'm largely talking about fund management, the mutual fund, that the larger name is drawing people to them very easily, one. And the leverage or the OPLEV is also becoming high, because naturally there is a 8-10% appreciation in the AUM by the natural course, irrespective of money coming in or no. And is that something that could drive? The small problem though that I have with that space is that there are only 2 listed players as of now.
They don't need to?
There are only 2 listed.
There are only 2 listed players, and there is not enough opportunity in at least asset management as of now. And one of them is priced to probably beyond perfection at the current point of time.
Yeah, I mean, I think the pricing valuation essentially will always kind of be an area of debate, and as long as the debate is there, the opportunity will be there. So traditionally, HDFC Bank has always looked upon to be basically an expensive kind of a stock, because I remember 20 years back, 10 years back, people still looked at HDFC Bank as price to book and saying, here is a PSU bank which trades at 1 time or 1.5 times price to book. Why do you want to pay 3 times, 4 times price to book? But I think what got missed in the process was essentially the kind of growth and the risk-adjusted basically growth which HDFC Bank was doing into, and they had some of the other things firing, like the CASA or the fee income and all of that, which ensured that the ROE was kind of high teens. That's what it ensured. So I think at times this whole debate about P multiples, etc., I think it's like missing the wood for the trees, in the sense that you get so caught up in looking at just that you miss out on what is basically the sustainable growth and the capital efficient growth that this business is going to produce over a long period of time. So I think and then I think any of these opportunities, so when you talk about the AMC Mutual, and there are only 2 listed players, but I wouldn't be surprised if more players come and get themselves listed, number 1.
In the works, yeah.
Number 2, any such emerging opportunity, you're better off being with that number 1, number 2, number 3 player rather than looking at that number 10 or number 20th player. So even if you look at what's happened in the NBFC, it's those 1 or 2 players which today finally are there. The rest of them are all essentially in some kind of controversy about their growth, about their books, about their balance sheet, about their liquidity situation, all of that. So even if it's an emerging opportunity, I think you're still better off being with that number 1, number 2, number 3 player rather than trying to kind of spot that number 8 or number 10 player.
I think financials not just has a majority weightage on the index, it has a majority weightage in all of our conversations as well.
But naturally so, right? It's such a wide bucket.
Yeah. But I want to now shift, since we've done almost a deep dive into financials. I just want to move on to some more pockets of interest. I mean, things have changed pretty dynamically for an industry like real estate. People have burned their hands badly. At one point, there was a meaningful representation of real estate even on the index. Now that's completely out. Real estate as a whole has become a slightly smaller industry or a smaller sector to be in. But still, if you look at it from a commercial real estate standpoint, things are doing well. The larger players with a better balance sheet are still hogging a lot of market share. Is that a space where also you see that kind of incremental growth coming in for the larger players? The smaller ones, obviously, they have that funding and liquidity issues that come about from time to time, but the larger ones are still doing okay.
Yeah, I think it's not been too bad a space, especially for the larger organized guys. And essentially, RERA has really, in a way, helped them. That it has ensured that, in RERA, only the quality, the compliant players are there. I think the big thing in real estate, I still think, is that it's still a very local play. And I think those companies which have survived and done well are not just compliant, but are also essentially remained local players, in the sense that I know this market and I'm going to stick to this market itself. So if you look at a player like Oberoi Realty, it's not gone out of Mumbai, for example. Okay, so I think that is very, very important, that to understand the intricacies of that business and therefore accordingly shape your investment strategy according to that. So I wouldn't rule out real estate as saying it's a space not to be touched. If at all, it's essentially been kind of a bit subdued space. Of course, there are still a lot of challenges in terms of approvals and ease of doing business and demand and all of that. But I think if we broadly believe that we are going to grow at substantially higher growth rates, if per capita income is going to shoot up, I still think that there is going to be demand for at least the affordable or the mid-income housing, and maybe
which is not a problem yet.
Yes, it's not a problem yet. So I still think that within the real estate space, we think there are pockets and there are individual companies who are reasonably capital efficient. They may not be as capital efficient as an FMCG company, but they're reasonably capital efficient, who are delivering ROEs in high teens. There is some bit of growth out there, and the balance sheets are intact, and there is no issue of governance, so to say. So I still think that all the normal ingredients that you would look for in an outstanding investment, I think if you apply same thing to essentially real estate, I think you will be able to spot one or two winners there as well.
My other question is actually it's more pointed. I'm not talking about the auto industry as a whole, but focusing a little bit more on the auto ancillary industry, and just looking forward a bit. If we're going to give a push to EV, we're going to give a push to more smart cars, as they call it, in the near term. How big an opportunity do you think it is for companies that operate in a space which provide high-end premium content for cars? They're pseudo IT. I'm just throwing an example like KPIT Tech, which is mainly into AI and the digital for autos. Minda Industries, they're getting on with their premium content business for cars. How big is this space, or is it still very nascent?
No, the space is big enough. Okay. The question is, if it is big, but is it going to be relevant for you as an investor? Because the challenge with some of these companies is that essentially their business is not necessarily linear. It's not kind of stable. It's very volatile. Tough to really, in a way, figure out what the next 1 quarter or the next 1 year or the next even 5 years is going to be. In the past, a lot of their growth has been driven through acquisitions, and clearly acquisitions may not be the most capital efficient way to basically grow your business. You will continue to need capital and all of that. So the bigger challenge, so yes, of course, you could have those phases where for a couple of years these stocks end up giving you solid returns. But I think beyond that, it's essentially tough to really kind of have some solid wealth creating returns in these kind of businesses.
You don't see perpetuity.
Absolutely. So I think when you kind of get into an opportunity like this, just ensure that you don't overstay and you don't overpay. These are the two things that you have to kind of just keep in mind. Then you need to have a very clear-cut exit strategy on day one.
Don't marry this.
Others, you'll essentially end up being an Abhimanyu.
Yeah, which you don't want. These days, so many people are saying Abhimanyu is not just beaten by the Kauravas, he's also being beaten by the Pandavas. So, debates. The other pocket, and Saurabh, coming on here because I think your portfolios have some of these names. Specialty chemicals, long spoken about, now a very large pocket as well, being believed as one which is not quite hit its peak. It's getting there, not quite hit its peak. What's your view here?
We've got Abbott Laboratories. I think that's the closest we get towards more a pharma play. We don't have spec chem, but you're right. There are good spec chem companies in the country. I think the way to think about whether it's spec chem, whether it is banking, insurance, or real estate, is I go back to this barrier to entry point, because the challenge I find in India, and I'll echo the Abhimanyu point, I find exit is the hardest thing to do in India. So our going in thesis as a firm is look for companies where you don't think of the exit, right? I'm not God. I cannot figure out when to sell the stock. I won't know whether the company's sector has peaked out, whether the growth has peaked out. All I can do as an investor is assess the barriers to entry. So if I know that the barriers to entry are extremely high and I can diligence that on an ongoing basis, that's the basis on which I stay. That's the basis on which I stay invested. So in spec chem, if you can find a company which has very powerful R&D, has some degree of intellectual property in its R&D, has strong customer relationships with global giants for procuring its products, then you've got a reason to believe there are barriers to entry and hence the returns will sustain. But if the spec chem story is because China there was an environmental crackdown, therefore demand has moved to India, therefore 2 years the company's done well, unfortunately that's where Nilesh is right. You will be overpaying and potentially overstaying very quickly, because when China will change its environmental rules, I simply don't know, right? So before one invests, right, rather than looking at last 3 years, how much money has the company made, how much has the stock run, a lot of people do that. Stock chala hai yani last 3 saal mein, what is the earnings growth? All of that I think is a little bit by the by. Look for proof, evidence, tangible evidence that the company has a very powerful barrier to entry. It is able to do something consistently that the competition can't. If you don't check that, then Nilesh's point on overpaying, overstaying, you're almost 100% going to get screwed. The Abhimanyu problem will be relevant for you. None of us can deal with the Abhimanyu problem by saying, I will look into a crystal ball and know when to get out. The best we've been able to figure out on the Abhimanyu problem is, is assess moats, assess competitive advantages, and basically look for monopoly franchises, companies who really don't have any competition to contend with.
Okay, so very close before we wrap up, just one final question to both of you. We've spoken at length about questions that we wanted to ask you. Let's talk about the longevity part here and pockets that you believe have that longevity for the next 3, 5, 10 years, if it's possible to predict that at the current point of time, where you would be comfortable betting in, not necessarily names, but themes that you are betting on. Maybe Nilesh has spoken about the non-lending financials. Saurabh, I can start off with you. That one theme that you believe has longevity.
So I reckon, even in spite of this talk about high valuations, I reckon there is considerable scope in India, especially in the post-GST, post-15% corporate tax world. There's considerable scope in India to build moated B2C consumer franchises in a range of industries, right? So from something as basic as regular tel, sabun, FMCG, to all the way through to I would say high-end manufacturing. I think it is possible, it is doable, very doable, to build large mega franchises which dominate your and my life with very high barriers to entry. So we'll continue looking for that. Similarly, as we go into a world where through the winter session, hopefully land reform gets expedited, through the budget session, hopefully we get middle class income tax cuts, and then hopefully next year we get labor reform. As you go through that, what I think we will see in sector after sector is one or two market leading players will reinforce their dominance because they'll have the free cash flow to reinvest, avail of the new reforms, they'll reinforce the dominance. So we're looking for companies who are in that pole position, have very strong free cash flows, and are therefore able to capitalize on the reforms which look likely to fructify over the next 6 to 12 months.
Nilesh?
Yeah, I think pretty much similar. I think clearly financials and consumer remain essentially the core of the India investment canvas. I think apart from that, maybe some of the manufacturing players, as domestic production kind of picks up with some of the reforms like GST, hopefully if labor reforms happen, and I think then probably Indian manufacturing will become more competitive, and there's clearly an opportunity there. And then, of course, niche technology. I think clearly that's where India's competitive edge is there in terms of a large pool of talent at a reasonable price. Of course, in the short term, currency fluctuations, etc., have some impact in terms of essentially their margins. But otherwise, I still think that niche technology is basically a great place to be in from an India standpoint.
All right, gentlemen, take a moment to thank both of you for joining in on this very special day. And to you and your teams, a very happy Diwali and a prosperous new year.
And happy
from all of us.
Dhanteras too.
Thanks a lot.